For decades, it seemed like nothing could slow down its rapid ascent. Today, however, the reality is starkly different. Economic momentum has slowed, structural weaknesses have surfaced, and China faces mounting challenges that could determine its future for decades to come. Will Beijing choose aggressive stimulus measures to reignite growth? Or is the country heading toward a prolonged period of stagnation, much like Japan in the 1990s? The outcome of this dilemma will have far-reaching implications, not only for China but for the entire global economy. Let's explore the critical factors shaping China's economic crossroads. 1. China's economic boom. Decades of unstoppable growth. For over 4 decades, China has been a remarkable economic success story. From the late 1970s, under Deng Xiaoping's reform and opening up policy, the country transitioned from a centrally planned economy to a more market-oriented system, setting the stage for rapid expansion. Between 1980 and 2010, China's GDP grew at an average rate of nearly 10% per year, a feat unparalleled in modern economic history. Several key factors fueled this growth. Massive infrastructure investments. China embarked on an infrastructure building spree, constructing highways, bridges, railways, airports, and entire cities at an unprecedented scale. The high-speed rail network alone expanded to become the world's largest. Manufacturing dominance. China became the global center for low-cost manufacturing, producing goods at a scale and efficiency unmatched anywhere else. This made China the world's largest exporter, transforming global supply chains. Real estate and urbanization boom. With home ownership rates exceeding 90%, real estate became a major driver of China's economy, accounting for nearly 30% of GDP. Financial market growth. While still tightly controlled, China's financial markets opened up enough to attract foreign investment, further fueling expansion. This model, however, relied heavily on investment-driven growth, credit expansion, and state intervention, all of which are now coming under strain. 2. Cracks in the foundation. Signs of economic trouble. China's economy is now flashing multiple warning signals that suggest it may be entering a period of prolonged stagnation. 1. The real estate collapse. For years, real estate was the backbone of China's economic expansion. However, the collapse of major developers like Evergrande and Country Garden has exposed deep vulnerabilities. Many projects remain unfinished, property prices are declining, and consumer confidence in the market has plummeted. With property accounting for up to 70% of household wealth, a downturn in this sector could have severe economic repercussions, reducing consumer spending and triggering a broader financial crisis. 2. Deflation and weak consumer demand. Unlike the US and Europe, which are grappling with inflation, China faces deflationary risks, a dangerous sign of economic stagnation. Falling prices indicate weak demand, discouraging businesses from investing and consumers from spending. Despite Beijing's attempts to boost domestic consumption, Chinese households remain cautious, opting to save rather than spend. This behavioral shift further slows economic momentum. 3. Rising youth unemployment. China's official youth unemployment rate soared past 21% before the government stopped publishing the data, a move that raised global skepticism about the true extent of the problem. The reality is that millions of highly educated young people are struggling to find jobs, particularly in tech, finance, and real estate. This trend risks creating a lost generation of workers who lack economic opportunities, further undermining social stability and consumer confidence. 4. The debt problem. Local governments in crisis. China's economic model relies heavily on state-directed investments, with local governments playing a key role in financing infrastructure projects. However, many of these governments are now deeply in debt, facing declining revenues from land sales. With few viable options to generate income, local governments are cutting services, delaying payments, and struggling to meet debt obligations, raising concerns about a broader financial crisis. 5. Sluggish industrial and export growth. China's industrial sector, once the engine of global manufacturing, is showing clear signs of weakness. With global demand slowing and Western companies diversifying their supply chains away from China, the country's exports are under pressure. Many multinational corporations are shifting production to Vietnam, India, and Mexico, raising questions about China's long-term role as the world's manufacturing hub. 3. The policy conundrum: stimulus or structural reform. Faced with these challenges, Beijing must decide whether to pursue large-scale stimulus to reignite growth or embark on painful structural reforms to build a more sustainable economic model. Option 1. Large-scale stimulus. A massive government stimulus could provide short-term economic relief by injecting liquidity into markets, stabilizing real estate, and boosting consumer confidence. However, this approach comes with risks. More debt accumulation. China already has one of the highest debt to GDP ratios in the world. Diminishing returns. Previous stimulus efforts have failed to deliver sustainable growth. Currency risks. Over-reliance on stimulus could weaken the yuan, leading to capital flight and destabilizing global markets. Option 2. Structural reform and economic rebalancing. Alternatively, China could focus on long-term economic reforms, shifting from an investment-driven model to one that prioritizes domestic consumption, technological innovation, and market efficiency. However, this would require reducing reliance on state-owned enterprises, SOEs, opening markets further to private enterprises and foreign investors, developing high-value industries such as AI, semiconductors, and green technology. While reform is the more sustainable path, it carries short-term economic pain, something Beijing may be reluctant to endure given political considerations. 4. Global implications. Why this matters to the world. China's economic struggles are not just a domestic issue. They have profound consequences for the global economy. Commodities and trade. A slowing China reduces demand for oil, metals, and agricultural goods, impacting exporters like Australia, Brazil, and Russia. Financial markets and currency wars. A weaker yuan could trigger currency devaluations and volatility in global markets. Geopolitical uncertainty. Economic weakness might push China toward more aggressive foreign policies, increasing tensions in Taiwan, the South China Sea, and global trade negotiations. Conclusion. What lies ahead? China is at a defining moment. A wrong move could push the world's second-largest economy into a prolonged period of stagnation, similar to Japan's lost decade. A well-executed reform strategy, however, could lay the foundation for a new era of sustainable growth. The question remains, will Beijing take bold steps toward economic reform? Or will it opt for short-term stimulus, postponing the inevitable? The choices made in the next 12 to 24 months will determine the future of China and the global economic order. If you found this analysis insightful, subscribe for more deep dives into global macroeconomics.